Holy smokes everyone, this is a holy smokes what the flippity flip flap flop, by crikey, huge super duper news, urgent emergency update. What you have to know right now, this is not a drill, the whole financial system right now is in cardiac arrest. It's failing, it's breaking, and nobody knows it yet. In this video, I'm going to give you a look under the hood or a look behind the curtain to show you what's really happening in the financial system, what's really wrong, why you should know about it. This is very, very important. Most people tune out when they hear about the economic system or economics. They think it's too boring. People, they design it for you that way. But don't worry, I'm going to make it sexy. I'm going to make it awesome. I'm going to make the best economic finance video you've ever seen in your life. Okay, let's get right into it. Looky here everyone, the demand for the Federal Reserve's reverse repo agreements is surging again. But I'm sure you've all heard this before, I'm sure you've seen other financial YouTubers talking about it before, but I've watched all their videos and all they're doing is reporting the news, just saying what's happening, but they're not saying why it's happening and what this means and why we should care. We don't care if, the Fed's swapping, treasuries overnight here and there, but there's much more to it than that. So for all of those of you that don't know what the repo market is, all these economists and financial gurus and these macroeconomist guys, they make it sound so damn complicated. And it took a while for me to get my head around it. But now I finally got it all figured out and I'll put it very, very simply and blunt for you. All the repo market is banks saying, hey man, I've got some treasury bills, I need cash. Can I borrow some cash from you and I'll give you these treasuries as collateral and then I'll pay you back interest. And the other bank is like, yeah, I want some treasuries. I'll lend you some of my cash and then I'll buy back that treasury from you later and you pay me interest. And what you have to know about the repo markets is, and why it's so important, it is literally the beating heart and the soul of the financial system. For example, to make it a bit more relatable to today, say for example, you see a beautiful woman, you see the eyes, the face, the body. That's all the parts that look good. This is kind of like the markets. The eyes is, say for example, the stock market. The face is a cryptocurrency market. The body is a housing market. That's all the sexy part of the markets. But underneath that is the heart and soul of that beautiful woman. And in the markets, there's the body, the face, the eyes, which is the housing market, stock market, cryptocurrency markets, all the sexy things. But underneath that body, there's a repo and money market funds. And those are the heart and soul of the markets. Now, if you say, why is that important? Well, just like that beautiful woman, if her heart and soul dies, well then all the beautiful parts of her die as well and she's gone forever and it breaks your heart and you cry yourself to sleep. Well, same thing with the financial markets. If the heart and soul of the financial markets fail, well then the stock market's going to fail, the crypto market's going to fail, and the housing market's going to fail. You're going to lose all your money, and just like that beautiful woman dying, you too will cry yourself to sleep when your portfolio crashes. Now again, what happened in 2008 was the money markets froze up, and that caused the financial crisis and the subprime crisis and caused the stock markets to crash and the housing market to crash. Well then again, in 2019, the repo market interest rate spiked because again, there was people like, I need money man. There was so much treasuries, but there wasn't enough cash. So the interest rate spiked up to 10%, and that caused a lot of fear in the markets. Then again, the money markets broke and the repo markets broke again in March 2020. And that caused another crash in the stock market. But again, going back to this article and what's actually going on now with the Federal Reserve, it's the reverse repurchase agreement market that is surging. And it's pretty much just the reverse of the repo market. A lot of these economists and gurus made it sound so complicated. What's the difference between the repo market and the reverse repo market? Well, the key there is in the name. It's just the reverse. So what's happening now is there's so much cash in the system, but there's not enough securities and not enough US treasuries. So what caused interest rates to spike in 2019 and for the repo market to fail then was there was too much treasuries and not enough cash, where now interest rates could go negative because there's too much cash and there's not enough treasuries. And here's why. Because what happened when you look at this chart of the treasury account in the US, they were flooded with cash from March all the way to August. So they've got huge amounts of cash. So the government didn't have to issue any more treasuries. So this means they've just been using cash and they're trying to drain the US Treasury account, which you can see here in this chart. I'll just scroll down a bit here so you can see that. So what this is causing is a shortage of treasuries. And if we look here, everyone, this is the daily amount the Federal Reserve is pumping into the repo markets. Now, when it started here, say for example, on the 12th of May, it was pumping in around 209 trillion. Then the next week, 235 billion, should I say. And then the next week, 241 billion. And then it's been going all the way up today. And just literally yesterday, for the 27th, they pumped $485 billion into the reverse repo market. Now, if you look at this chart here, this is the amount of treasuries the Federal Reserve is having to pump into the reverse repo markets. Because again, what's happening now is there's so much cash because what the Federal Reserve has done with their QE is they've brought, if you look at their balance sheet here, it's around $8 trillion. They've brought all these mortgage-backed securities, all these treasuries. When again we go back to this chart here, when there's a dwindling supply and dwindling amount of new treasuries being created, what this is creating is a shortage of treasuries. So the banks don't have treasuries to sell to each other. So they're now having to go to the Fed. And when we look here, these are spikes and these are normal because normally these spikes happen at the end of a quarter when the banks try to beef up their balance sheet and make their balance sheets look better. But we're not at the end of a quarter. And if we look at the chart here, it just hit a record, like I said before, if we look back at history, of $485 billion the Federal Reserve is having to pump into this reverse repo market program. And like I said in my previous video, the Fed is now radically transforming funding markets, and they're now making these temporary repo market operations permanent. Remember in September, the Fed was like, guys, there's nothing to see here. Don't look over here. Everything's fine. We're just temporarily pumping liquidity in. Well, now they're completely overtaking the whole financial system. Do you know why? Do you think this is healthy? Do you think this is good? No, it's because when you mess with free markets, when you try to completely control or have complete totalitarianism and complete market control over the economy, humans make mistakes and they break things. And the Federal Reserve is completely breaking a very complex financial system. They're pumping liquidity here into the repo markets, but then the reverse repo market stuff up. They're pumping money into this market, but then this market stuffs up. They've completely broken and they're losing control of the whole financial system. Now you're probably thinking, well, why should I care? Well, what's happening is there's slowly becoming less and less places for banks and money markets to park their cash. As you can see here, the 1 month treasury is now at zero, and yesterday the 2 month treasury rate or the bond rate yield went to zero as well. So what's happening is there's less and less places for the banks to park their money. So now they're parking it at the Fed, because you know why? If all of a sudden all these banks pump trillions of dollars into the short-term treasury markets, the yields would go negative. We'd have negative interest rates, and this would completely spook the markets, because the markets will say, what's going on? The Federal Reserve didn't implement negative interest rates. Why are the markets going negative? What's going on here? And the markets would start to sell off. So what this means is QE, money printing, has actually broken the markets, because now there is too much cash and not enough securities like treasuries to go around. So what this means is the Federal Reserve is going to have to taper its balance sheet, whether it likes it or not, because it's going to have to start offloading its treasuries so these banks and money market funds can have some, otherwise rates are going to go negative. And what this also means is they're going to have to lift interest rates, because if they don't, rates are going to go negative. And again, this is why it's so important for the markets, because this is the chart I always show. The red line is the S&P 500. The blue is the Federal Reserve's balance sheet and the ECB and the BOJ in dollars. And as we can see here, if the Fed tapers, the market falls as well. It's correlated. So the Federal Reserve doesn't want to reduce its balance sheet, because then the markets are going to say, hey, you're tapering, and then they're going to sell off. But look what they're doing now. They're actually doing something absolutely crazy. They're doing smoke and mirrors, and all this QE now is turning into fake accounting, and pretty much fraud. Listen to this, everyone. When the desk, that is the New York Fed's desk, conducts reverse repo market operations, it sells securities held in the system open market account to eligible bodies like other commercial banks, other international central banks, hedge funds, money market funds, counterparties, with an agreement to buy those assets back on the reverse repo market's specified maturity date. So the Federal Reserve is selling these treasuries to these banks, but listen to this. This is crazy. This leaves the system open market account portfolio the same size. As securities sold temporarily under repurchase agreements continue to be shown as assets held by the system open market account, aka the Fed's balance sheet, in accordance with generally accepted accounting principles. What the heck is generally accepted accounting principles? You know what this is? There's just them fudging and playing with the numbers, and it's just all digits on a screen, and it's all smoke and mirrors, and they're not actually expanding their balance sheet or doing QE. All they're doing is doing swaps with each other. So what that means is, with the Fed's balance sheet, is they're actually reducing it, but they're not updating it because they're selling these treasuries and they're saying, hey, this is just temporary, so we're not going to update our balance sheet. We still own those treasuries. How crazy and stupid is that? And if you look at this, since we've had this crazy week in the reverse repo markets with them selling off all these treasuries, normally they update their balance sheet weekly. But the last update we got was from May 18th. So why haven't they updated their balance sheet yet? Since this crazy reverse repo market operations began, there's something very suspicious going on here. Okay, everyone, huddle in, let's bring it home. So again, to summarize what this means for us, this means the markets are broken. The reverse repurchase operations, all it means is all these banks, they want treasuries, they've got too much cash, and they're willing to buy these treasuries and pay a negative yield just to get them because cash is becoming trash right now and it's becoming worthless and there's too much in the system. And what this means is the Federal Reserve is having to sell hundreds and hundreds of billions, nearly $500 billion in treasuries, but they're not updating their balance sheet to show that they're actually tapering right now. And like I said, this means yields could go negative. And like I said, we're in a shortage of treasuries, so the Federal Reserve has no choice. They have to taper now. They have to get rid of all this liquidity that's in the system. They have to offload these treasuries. So we're going to see a taper, and markets hate it when the Federal Reserve tapers, and they're going to have to start lifting interest rates so that yields don't go negative. And not to mention all this, we've also got inflation running out of control. So that's another reason they're going to have to taper, and another reason they're going to have to lift interest rates. And again, why we should care, because if they do taper, if they do lift interest rates, because of this crazy things that are going on in the repo markets, that means the dollar's going to go up. And when the dollar goes up and interest rates go up, stocks are going to fall, real estate's going to fall if interest rates do get really high, and also the cryptocurrency market is going to continue to fall. So everyone, I know this is a crazy topic. It's a little complicated, but I hope I was able to simplify it for you and tell you what's really going on in the financial system right now. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you up to date on the latest happening in the stock market, housing market, and the global economy. If you're bored, I'll put up some other videos here. I'll see you there.